Hello. In this video, we'll be going through correction of an error, part 2, prior period adjustments. Many accounting changes take place for various reasons, and one of those reasons can be a correction of an error. And that it just means that there's a error, a mistake caused by a transaction being recorded incorrectly or not at all. These could be because of mathematical mistakes, inaccurate physical account of inventory, so therefore your ending inventory is wrong, a change from the cash basis of accounting to the accrual basis, where GAAP only allows accrual for corporations, failure to record an adjusting entry, recording assets and expense, or vice versa, or there could even be just fraud or gross negligence. Whatever the reason is, if an error is material and affects the presentation of prior periods or the accounts, we need to account for it properly. Most errors affect a prior year's net income. And when that happens, that means that the prior year retained earnings was incorrect because net income goes as part of retained earnings, right? Because you have your beginnings retained earnings plus net income minus dividends equals your ending retained earnings. So if your net income is overstated, let's just say it's too high, then your ending retained earnings is too high, which flows into the next year's beginning retained earnings. So, and vice versa. If one's too low, the other one's too low. So if there's a net income issue, an error in the net income from the prior year, then that's going to affect your retained earnings, which also needs to be corrected. So in that situation, both the income statement and the balance sheet must be restated. So we've learned in prior videos that restated means that the financial statements need to be restated as if the error had never happened. And we also have to think about income taxes when it comes to income errors, because if the error is material enough, the corporation may need to amend their prior year tax returns to either reflect more income and therefore pay more taxes, or less income and claim a refund for taxes overpaid. When we need to reflect an adjustment to retained earnings because of a correction of an error, the way we do that is we show what's called a prior period adjustment on the face of the financial. And this is just an adjustment to the beginning retained earnings. So when we have a error, the way we correct it is step one, in the year that we discover the error, we have to record a journal entry to correct any of the account balances that are incorrect, right, as a result of the error. The second step has to do with the financial statements that are shown, right, in the 10K, and they have to be what's called retrospectively restated, and we've learned this term through the previous videos for accounting changes. And that means that the prior year's financial statements have to reflect the correction, and that has to be done for all the years shown so that they can each be compared to one another. And what I just discussed about the prior period adjustment, if retained earnings is one of the accounts that's incorrect, then a correction has to be reported as a prior period adjustment to the beginning balance in the statement of shareholders equity or the statement of retained earnings if that's presented instead. And then you have to write a disclosure noting the nature of the error and which line items on the financial statements changed and any earnings per share amounts that are affected for each of the prior periods presented. So here's a small, just so we can show you visually how a prior period adjustment looks. We have a 2026, let's just say it's a 2026 10K, where we show 2 years worth of, this is the statement of retained earnings, where we have our beginning balance at the beginning of the year, net income less dividends is the balance at the end of the year, and the 2025 balance of $600,000 rolls into as the beginning balance in 2026, and so on and so forth. Let's move forward to the 2027 year, and let's just say we discovered an error for from 2026. So we saw here our our 2026 retained earnings, we have to show it exactly the same way. So in 2026, the beginning balance was 600,000, which is what we're going to show as our 2026 beginning balance. But now we've discovered that we need to reduce our retained earnings because our net income got reduced in prior year, right? We overstated our net income in prior year. It should have been $20,000 less. So we're going to have what's called the prior period adjustment. And now we have a corrected balance. And then we can add in the 2026 income, net income, less dividends, gives us a new balance at the end of 2026 for $780,000. And that is what gets put as the new beginning balance for 2027. And then you just reflect all the 2027 activity for that year. Now, we're going to go through this example and then we'll work through some different scenarios. In 2027, internal auditors discovered that Seidman Distribution Inc. had debited an expense account for the $7 million cost of sorting equipment purchased in the beginning of 2025. The equipment's useful life was expected to be 5 years with no residual value. Straight line depreciation is used by Seidman. Let's see what should have happened. They acquired a piece of equipment for $7 million in 2025, okay? And in 2027, they discovered an error that they had expensed that full $7 million in 2025 when they acquired it. But let's just see what should have happened. They should have, in 2025, debited equipment, credited cash, and then when you take the 7 million divided by the 5 years, you got 1.4 of depreciation expense per year. Okay, that was really messy, but and so at the end of 2025, we should have debited depreciation expense 1.4 and accumulated depreciation 1.4, and then in 2026 had the same journal entry. But instead, what happened is that in 2025, we debited expense and credited cash, and we omitted the depreciation entry both at the end of 2025 and in 2026. So let's see how this affects our retained earnings. Our total, when we come into 2027, right, when we're looking at our beginning retained earnings for 2027, what are we missing, right? Well, we have too much expense for 7 million, but then we're also missing this $1.4 million depreciation expense from 2025 and 2026. That would have all been included as part of the 2027 beginning retained earnings. So what does that mean? The total expenses were overstated by $7 million, less the $2.8 million for the depreciation for the 2 years, which gives us a net overstatement of expenses of 4.2 million, which means that net income was understated by 4.2. When you're doing these kind of correction of errors and thinking it through, my recommendation is you do it really slowly and write it down. If you can't do it in your head, write it down, because when you have to think about, okay, if my expenses were, you have to think, are my expenses overstated? Are they understated? And then how does that reflect in my net income? Same thing with income. If your total income from prior years is overstated, understated, what is that going to do to your net income? And then in turn, how does that affect your retained earnings? So it's like multiple steps. So if it helps to write it down, then you should. Okay. So back to our scenario, our net income is understated by $4.2 million, which means our retained earnings at the beginning of 2027 is also understated by $4.2 million. So we need to have an adjustment recorded in our books for increasing retained earnings for $4.2 million. We're also missing this accumulated depreciation expense in our books, right? It's the $1.4 million credit here and $1.4 million credit in 2026, right? So we're missing $2.8 million of credit to accumulated depreciation. And what we don't have is we don't have this journal entry either. We never capitalized that equipment because we expensed it. So we must capitalize our equipment. So let's look at the journal entry that we would record in 2027. We would capitalize equipment for $7 million, so we would debit equipment $7 million. Here we would credit accumulated depreciation for the 2.8 and credit retained earnings for the 4.2, right? So the 2.8 increases accumulated depreciation and the 4.2 increases retained earnings. Okay, so this is, think of this part is, here's what I need to do. This is step one to correct my books, my general ledger. The next thing you have to do is, okay, now I have my books are correct. How am I going to reflect this in the actual financial statements that I'm going to issue? If you have, and it really depends on if you have comparative statements, right? If you have multiple statements showing and which years are showing. Now, before I get into that, I just want to say, let's just look at how, if we rewind to 2026, this is how it was reported in 2026. And let's just say 2025 was the first year that we were in business. So, and I put $25,000 of sales for each year just to make it more clear as to how everything flows through. So in 2025, this is how the income statement and statement retained earnings were reported. With sales of 25, recorded machinery expense for $7,000. So the net income was $18,000. And we go down to our statement of retained earnings. We had our beginning retained earnings is 0. Our net income is 18,000. So our ending retained earnings is 18,000. And then 2026, we had sales of 25,000 and we had no depreciation expense. Because remember, let's just say this is 2026, the error has not yet been discovered. Okay. And then, so when we flow down to our statement of retained earnings, our beginning retained earnings is last year's ending, which is 18,000. Current year net income of 25. Ending retained earnings is 43,000. Now we're in 2027, and we realized that this entry right here was incorrect, right? We should not have had machinery expense for 7,000. We should have capitalized that and just had depreciation expense for $1,400. So when we restate our financials, and the year the error originated is actually reflected in the financial statements, this is what happens. We have our restated income statement with our sales of 25 and depreciation expense of 1,400. Notice there's nothing here for machinery expense. And we have a new net income of 23,600. Retained earnings, first year in business, 0. Net income is the 23.6. Our ending retained earnings is 23.6. Then we need to reflect the 2026 year on our financial statement. Sales 25, depreciation expense 1,400. Net income once again is 23,600. And our beginning retained earnings for 2026 is now our new restated ending retained earnings from the end of 2025. And we just keep rolling forward every year. And in this situation, there is no prior period adjustment being shown on the face of the financials because we're showing the year that the error originated in. Okay, and so in that case, it's just that if the first year that we're showing is the year that the error originated in, we do not need to reflect a prior period adjustment because it just automatically flows through. Now let's go to a different scenario where the year the error originated is not actually shown in the financial statements, but we still have comparative statements. We're still showing 2 years worth. So here's how everything was reported last year for 2026 and 2027 on the income statement, right? We had our sales of 25,000 in the year 2026, and that's our total net income. Our beginning retained earnings was 18,000, and then net income was 25. So my ending retained earnings is 43,000. And then now it's 2027 and we've discovered this error. So when we report our financial statements in only 2 years worth, we report our sales on our income statement of 25, depreciation expense for 1,400, and net income is $23,600. I just want to point out also that, I have this here saying restated, but 2027 is not restated, right? Because we're in the 2027 year. So this is just how we reported it. It's just the way I built this Excel file. But just know 2027 is not restated. It's because we're in the 2027 year. This is how we're originally reporting it. When I say restated, it means the prior years are restated. Now, this is where your prior period adjustment comes in. Your beginning retained earnings for 2026 is going to be the same as it was reported last year. It's the ending retained earnings from the prior year, which even though it's not shown in the financial statements, we know our ending retained earnings for 2025 was $18,000. So that has to be our beginning. Now we need to adjust our beginning retained earnings for 2026 with what's called the prior period adjustment. And let's go here to see how it's calculated. So our beginning 2026 retained earnings is understated, right? Because we had an overstatement of the machinery expense, but that's slightly offset by the depreciation expense we should have taken. So we had $5,600 of too much expenses from 2025, which means that our net income was understated in 2025 by this $5,600, which means our retained earnings was understated by that same amount. So that's what we have to increase our retained earnings. So in this situation, we're going to have a prior period adjustment, increasing retained earnings by $5,600, and now my restated beginning balance of my retained earnings is $23,600 plus my net income of $23,600. It just happens to be the same number. That's not, that's just a coincidence. And so my ending retained earnings for restated for 2026 is $47,200. And then for 2027, I just go about my day like I normally would, right? Here's my income statement. My beginning retained earnings is last year's ending, and I just do my statement of retained earnings the same way I always would. Okay. Third and final scenario is if we only report a single year financial statement, which is in our scenario 2027, which is the year we discover the error. So here's my income statement. My sales at 25, depreciation expense 1,400, net income 23,600. My beginning retained earnings for 2027, remember, this is the year we discovered it, is going to be my ending retained earnings from 2026 as we reported it. And if I go up here to my scenario 1, this is how we reported it. And my ending retained earnings in 2026 was $43,000, which means my beginning retained earnings is $43,000. And I have to do a prior period adjustment. Let's look at the prior period adjustment amount if I just show a single year financial statement. So my prior period adjustment for 2027 has to reflect, we have to reflect all the adjustments that should have been in place for the prior years that were incorrect. If I'm just looking at 2027, 2025 was incorrect because it had my net income had too much expense by $7,000, but it should have also taken in depreciation expense for $1,400, as well as my 2026 year should have also had depreciation expense of $1,400. So my net income was understated by $4,200, and therefore it has to be now increased, right? And if my net income was understated, my retained earnings has been understated. So I need to increase my retained earnings by $4,200 in 2027. And then I get a restated beginning retained earnings for $47,200 plus my current year net income gives me ending retained earnings of $70,800. I'm going to scroll all the way to the top. I want to point out the ending retained earnings for 2027 under each of the scenario. Here's my ending retained earnings: 70,800 scenario 1, 70,800 for scenario 2, and 70,800 for scenario 3. That makes sense. That's how it should be, but just the way it's reflected in the financials is different depending on when we discover the error. Let's just say, I didn't put this here, but our final scenario that this wasn't discovered until 2030 or 2031, when this asset would have been completely depreciated. Well, in that situation, no correcting entry would be needed at all, because it's just self-correcting. Because even though the errors, each year that's shown has an error, at the end of the day, because it's all depreciated, it just the errors have corrected themselves because the retained earnings number is right. Eventually, we would have gone $7,000 of depreciation expense, except we just took it in 1 year instead of over 5. But when you're looking at 2030, at that point, it's self-corrected and we do not restate our financial statements. And then finally, the last step whenever you discover an error is that there must be a disclosure note accompanying your financial statements that needs to describe the nature of the error and the impact of the correction on each financial statement line item, and any earnings per share amounts affected for each prior period presented. So your disclosure note might change depending on which years are actually reflected in the financial statements, but they always have to be there. You always must have a disclosure note. Let's do a concept check. Which of the following is not true regarding the correction of an error? A journal entry is made to correct any account balances that are incorrect as a result of the error. Well, that's has to happen, so it's not A. B is that prior year's financial statements are restated to reflect the correction of the error as if the error had never occurred. Yes, we do have to reflect that, so that's not B. C is the correction is reported prospectively. Previous financial statements are not revised. This is incorrect. When you have a correction of error, you must restate your prior financial statements to reflect that correction. And so we know that D is not the answer, because you must also have a disclosure note that describes the nature of the error and any earnings per share amounts are affected by each prior period presented. So the answer is C.